Good afternoon. My name is Sonora Monks, ESA's Director of Programs and Education. Thank you for attending today's webinar titled Federal Tax Credits for Renewables and Storage. Today's webinar is being recorded and will be available at www.energystorage.org. Participant lines will be muted throughout the webinar. However, we welcome your questions and comments, which can be submitted at any time via the chat box on the left side of your screen. Following the webinar, you will receive a link to the recording and slides, as well as a brief survey regarding today's topics and topics for future webinars. Your feedback will ensure that ESA continues to provide the highest value information to you and your company. Today's speakers are Brian Americas, who is Senior Manager with Deloitte Taxes Washington National Tax Practice, and Gary Tekimovich, who is Partner at Deloitte Taxes Washington National Tax Office. Thank you for the time, and without further ado, I'll turn it over to Gary to begin today's presentation. Gary?
Great. Hello, everyone. Thank you for joining. We hope we have a really good presentation for you. Want to cover some really, kind of hot off the presses news on the battery storage front as it relates to some tax benefits, the investment tax credit. So here's our agenda for the day for an hour together. We're going to cover a background on energy tax credits generally. We're going to talk about the evolution in the tax code of the treatment of storage. And then Brian Americas here is going to join us to tell us about a new private letter ruling that Deloitte was successful in getting for one of our clients, which first of its kind, and we'll sort of put that in context, the relevancy of that PLR, and we hope to answer any of your questions you have about that. That's the big new news on the energy storage front in the investment tax credit. And then we'll talk about looking ahead, and then we'll take questions. So please type in your questions as we go. And Brian and I will try to get to as many as we can during our presentation. Just a little further background on myself and Brian. I'm a partner in our Washington National Tax Practice. I've been with the firm for over 20 years. I am the firm's leader on tax credits and incentives, which includes the energy tax credits, including the investment tax credit. Brian Americas, who's joined as a senior manager, I hired him from the IRS. He was an attorney over at the IRS branch that deals with the energy tax credit, and he is affectionately known in the industry as the godfather of the begun construction guidance since he drafted the first two notices. We'll talk about that briefly. So let's get going now into the substance. So what does storage have to do with energy tax credits? For some time we've followed the trajectory of the cost of energy storage coming down and being more commercially feasible to add energy storage to all kinds of different applications. One application in particular has garnered a lot of interest, and that is pairing storage with wind, solar, or other alternative energy or renewable energy resources. Many times pairing storage with renewable energy makes a lot of sense for some of the reasons that we'll talk about. And in particular, there are incentives in the tax code that incentivize investment in renewable energy and will continue to do so in the immediate time horizon. So one of the key benefits of pairing storage with renewable energy is in many cases the investment made in the storage related assets when paired with renewable energy can qualify for very significant federal income tax benefits. For some period of time there was some uncertainty about what might happen with respect to the federal tax law around renewable energy. Those matters have been settled for the foreseeable future with the Tax Reform Act that was signed into law recently, and I think we have a pretty understood playing field going forward with respect to the incentives that are out there from a federal income tax perspective associated with renewable energy and the pairing with storage. those are all really good factors, along with the fact that the costs are continuing to come down. I know in our practice at Deloitte, we are starting to see, very frequently now, we are looking at configurations, in particular with solar paired with storage, where investments are being made up front, and tax investors who are primarily benefiting for the tax incentives, what's referred to as tax equity investors, are making investments and benefiting on the basis of costs incurred related to both the renewable energy resource, like a solar farm installation, as well as the storage which is paired with it. So we're really starting to see this take off in the marketplace, and we're going to talk about some of the background here, how you can qualify. So let's go to the next slide. The next slide is emerging use cases. This is a really nice slide provided by the Rocky Mountain Institute. This is really a summary of the different ways in which storage can be used, both within utility services, the transmission, ISO, RTO services, and then customer services. I'll point out a couple of the most frequent use cases that we see. We often see with utility scale solar or wind projects, we see storage being integrated with configurations that involve frequency regulation and energy arbitrage. And then on the residential application, we often see applications involving backup power and time of use bill management. Those are a couple of the more common configurations we see. But this is a nice summary of the various types of emerging use cases for energy storage. The next slide, this is summarizing some of the primary federal tax benefits under the law. The two biggest ones that most of you are probably familiar with is, in the context of wind in particular, there's a production tax credit that is worth 2 cents per kilowatt hour for a 10-year period. That's inflation adjusted. That was retained as part of tax reform. There is a phase down that we'll talk about with respect to that credit, actually a phase out. And then the investment tax credit is a 30% investment tax credit, which is going to phase down and eventually out. And this is really, this is solar installations. The investment tax credit applies to some other technologies, which we'll see were recently extended as part of the Budget Act, which was signed into law after the Tax Reform Act just in the past several weeks here by Congress. The other big benefits typically are accelerated depreciation. The general rule for battery storage, if it's integrated in a wind and solar application, then it will be considered 5-year maker's property, meaning you can write off those costs over a 5-year accelerated depreciation schedule. And importantly, in the tax reform bill, for a period of time, Congress provided a bonus depreciation, 100% expensing for certain investments, and that would include wind, solar, or integrated battery storage when it is integrated into a wind or solar or other renewable energy context. So those are all very valuable tax incentives for making those investments. I'm going to go to the next slide. We just have a couple more slides. These are a little more detailed. I'm not going to dig into this very deeply, but this is good reference material for you. This is a summary of all the various types of technologies for renewable resources and the tax credits and the phase-down period. There's a beginning of construction requirement. You can see here, this slide is for the production tax credit. By far the biggest investment is in wind in the United States. We are seeing a lot more in the way of biomass. Definitely there's geothermal. There's hydropower. So we're really seeing all of these technologies. And any of these technologies that integrate battery storage or energy storage can qualify as well for incentives, either the accelerated depreciation or the ITC. The production tax credit, I'll just note, doesn't have a lot of value in that context because the measurement is based on the kilowatt hours of electricity sold to a third party. So the main focus for energy storage historically has been the investment tax credit, not the PTC. I do want to dispel one rumor or what Deloitte believes is not accurate reading of the law, and that is if you pair an energy storage device with a wind project, a project that is already qualifying for the PTC, there's some debate about whether the energy storage assets that are integrated to the wind facility could qualify for the ITC in that context. Our view is that it cannot. That is something we've researched quite extensively, and I believe there's a few pockets of disagreement on that, but I wanted to make that clear that that is Deloitte's view. Next slide is our Section 48 credits, and we often see probably the most common configuration is pairing storage with solar. So this is very relevant. The top line there shows the ITC rate as it's going to phase down from 30% down to 10% with respect to when a project begins construction. The government is working on guidance on beginning of construction. That guidance is expected probably late summer, and it's expected to follow the general path and the guidance under 6 notices that were applied for wind. We're expecting something similar. So stay tuned to that. The key requirement for safe harboring, if you have projects that are going to be placed in service after 2020 to qualify for the 30%, you have to begin construction, and that's outside the scope of this presentation, but suffice it to say there's a lot of nuances and rules regarding how you grandfather a project. Energy storage and solar projects that are placed in service prior to 2020 will automatically qualify for the full 30%, subject to some of the integration rules that we'll talk about a little further here when you're pairing storage with a solar electric generation facility. I'm not going to go over some of these other items. There are other items that were extended as part of the Budget Act, and those are included in these slides. And last, and this is really relevant for the most recent private letter ruling, 25 Cap D was extended in the code. This is the investment tax credit for residential property as an individual. If you install solar on your home, you install solar plus storage on your home, you have the potential of qualifying for the 30% ITC, which phases down based on a placed in service date deadline as opposed to a beginning of construction. So these dates are very relevant in this slide. The good news, again, for all of this is the fact that the rules are set in place. I will say Congress is completely exhausted from the tax reform machinations that happened over a series of weeks, and the next couple of years the federal government is going to be, at least on the tax side, is going to be completely dedicated to writing rules on the many gray areas and areas of question under the rules. So the good news, we think all the rules are set in place right now for project finance going forward on storage projects that are integrated with renewable energy. So that's a very good development. Okay, let's switch focuses now and just get down to the historical tax treatment of energy storage. It actually traces back to 1962. Some of you on the phone may have been around in 1962. I personally wasn't around at that time, so I can't speak from firsthand knowledge what Congress was thinking back in 1962, but we certainly trace that forward to today. Back in 1962, and when Congress was writing regulations for the treatment of the investment tax credit, it did include in 1978 in the regulations storage devices. At the time, we didn't really have electrical storage. We had solar thermal storage. So the rules that were written in the old regs really are written from a technology standpoint related to thermal storage. In 1978, when they wrote the regs, there was a rule written that basically the storage equipment itself had to be 100% solely used to store the thermal energy generated by solar in the solar thermal context. Eventually, the IRS came back and reconsidered the legislative intent under the energy tax credit and proposed regs, and eventually rewrote the regs and included what is referred to as the 75% cliff. We'll see that the 75% cliff is a very important dynamic for energy storage in determining the amount of the credit or even base eligibility for the credit for storage. And this resides in the current regulations under the old Section 48. Eventually Congress came around and they got rid of most of the investment tax credit in the code. There was an old energy tax credit under 48L. Portions of that were retained and included and carried forward after tax reform several decades ago, and that is what we're living with today. Those old regulations are still relied upon by investors in the IRS today, so they still have effect. And so this 75% cliff is sort of the law of the land until or unless Treasury goes back and revisits and rewrites regs, which we'll talk about a little further. So let me go to, again, to the historical treatment. The regs treat certain property as dual-use property, including energy storage devices. What that means is the 75% cliff requires you to bifurcate assets between assets that are dual use and non-dual use assets. For the dual use assets, you have to evaluate the percentage use of those assets between a qualifying activity and a non-qualifying activity. The qualifying activity in the context of an ITC for solar is generating electricity from the sunlight. So the storage that is dedicated to that activity, which stores electricity that is generated from the sun and ultimately transmitted after storage and sold to a third party or transmitted in another way for useful energy, that is qualifying. And then to the extent that a battery is charging from a non-qualifying resource, let's say grid energy, energy that cannot be traced to the solar resource, that is non-qualifying. So the old regs provide this 75% cliff where if you have more than 25% of the total of the energy input in the storage device or the storage asset comes from a non-qualifying resource, then the asset is disqualified in its entirety for any portion of the credit. And that's why it's referred to as a 75% cliff. In other words, 75% of the energy inputs have to be traced to a qualifying resource. So this language that you see in the slide is taken out of the regulation. This is the specific language in the regulation. And the government, when they wrote these regs, again, they were thinking of solar thermal and other dual-use equipment, and they talk about an annual measuring period of 365 days and doing an analysis based on a BTU basis. That makes a lot of sense for thermal storage. And that's about it in the historical treatment in the regs. The regs do allow the Commissioner of the IRS to accept another method that isn't measuring on a BTU basis, but leaves it silent on what would be acceptable. The key element here for any storage that is paired with a renewable energy resource is you have to have some means by metering the assets of determining your compliance with the 75% cliff. As long as you can measure on an annual basis on some frequency, the frequency is debated by parties, but as long as you can measure and support that the battery is charging and discharging with solar or another renewable energy resource qualifying for the credit, and it's doing so at above 75%, then you are eligible for the credit. The credit is haircut to the extent it's not 100%. So there is a tax credit recapture rules that can apply. Let's say that in year one, the battery is 80%, the energy inputs are tracing from solar activity, and another 20% from a non-solar activity. Then you would get 80% of the 30% amount would qualify as a credit, 24% of the battery. In year two, if that 80% went down to 75%, that 5% differential would be recaptured. If you went up from 80% to, let's say, 90%, there is no provision that allows you to get additional ITC. And this, again, is why it's referred to as a cliff. As a practical matter, in the configurations we see, companies will meter their energy storage devices. Oftentimes they'll have software that is able to physically trace and charge and discharge the battery at certain times, where a party can put together the data to prove that the battery is charging from renewable resources as opposed to non-renewable resources. Let me leave it at the configurations. The metering are all very fact-specific items that have to be evaluated in determining ITC eligibility, and I would say there's a diverse set of practices in the industry with regard to that. Okay, so back to the historical treatment. This next slide, this is what you have in the way of guidance in the regs. Again, the regs were written on the basis of solar thermal. The regs have an example that includes these various assets in the solar thermal context, and they point out that the solar energy property, 100% eligible for the credit, include a roof solar collector, the pumps between the water tank collector, pipes, hot water tank, heat exchanger, etc. The ineligible items would be auxiliary equipment like an oil-fired water heater, which is providing supplemental heat for the water in a solar thermal context. And then the dual-use equipment is the equipment that is in the configuration using both qualifying energy inputs and non-qualifying energy inputs. So in the example in the regs, in the solar thermal example, it includes a distribution pipe, control components, etc. So this specific example is in the historical record. In a solar thermal context, the example shows an 80% qualification, and this is what we have by way of written guidance on energy storage in the law. So now let's go to the recent evolution of the tax treatment. So more recently, there's been kind of an explosion in additional guidance with respect to how you apply these dual-use rules under the old regs. We'll see in a minute there have been several private letter rulings, including the new one that Brian is going to go through that Deloitte assisted on. But then there have also been a number of court cases involving the Section 1603 grant. None of those cases are dealing with battery storage. However, many of those cases are dealing with systems that involve steam generation from biomass, where the steam being generated is partially serving a process thermal heat benefit and partially electrical production benefit. And in those cases, the government and taxpayers are litigating over how much of the credit qualifies. You get the full 30%, you have to take a haircut because the property is dual-use equipment, and generally the courts have been coming out requiring a haircut based on a reasonable interpretation of the measurement of a system between the assets that are engaged in the qualifying versus non-qualifying activity and how those assets are used. Again, very fact-specific, and the law is still evolving there, but important to consider when we're evaluating battery storage. All right, let's cut to the chase on battery storage. What we actually have in the way of guidance are private letter rulings. What is a private letter ruling? A private letter ruling is taxpayer-specific guidance. It is not precedential. So when you go and you evaluate the law for a particular fact pattern, a private letter ruling is not binding on the government for another taxpayer. The private letter ruling is binding on the government with respect to the particular taxpayer's facts. So once you have a private letter ruling under your specific facts, the government is beholden to its judgment and its ruling, and they cannot kind of change their mind with respect to that ruling. PLRs are also used by tax lawyers in evaluating, especially in areas where there's very little administrative guidance or regulatory guidance. As we talked about, there is very little regulatory guidance on well, what we do have is on thermal storage. We don't really have battery or electric storage in the old regulations. So taxpayers and their tax counsel take a great deal of interest in where the IRS is on these matters, and there are several private letter rulings that have come out that we'll talk about. And then, of course, we'll talk about the most recent private letter ruling. So this next slide is just a summary of the authorities. So, the most precedential authority is the Internal Revenue Code itself, then the Treasury regulations, other administrative guidance, and then lower down on the scale, you'll see things like private letter rulings, which are cited by tax lawyers when they're evaluating a position of a particular taxpayer, and then the bottom line is other things like instructions, forms, FAQs, etc. So a private letter ruling is important, but again, the government isn't bound under another fact pattern because private letter rulings are typically very fact-specific to a taxpayer's configuration. And we definitely see that in the context of battery storage paired with renewable energy. Okay, so here are the private letter rulings to date. We are going to see that there are exactly 5 private letter rulings prior to the 6th, which was received recently by a Deloitte client. This is a real good summary of the private letter rulings. The government's views have evolved on the pairing of battery storage with renewable energy. Back in 2011 was the first ruling where a battery was included with a utility-scale wind project. The IRS analysis mentioned the dual-use rules, but only concluded that the property wasn't auxiliary equipment. So in other words, it didn't really apply a 75% cliff, although it mentioned the dual-use rules. Then later on in 2011, this was a very significant ruling, the October 27, 2011 ruling. I believe this was the first retrofit ruling. This is where a taxpayer had a 1603 cash grant on a wind farm in Texas. They applied and applied for a private letter ruling when they added battery storage for time shifting and frequency regulation at their merchant wind project down in Texas, and the government ruled that they could qualify for the ITC. Now remember, that was not a production tax credit project. That was a grant project. That's very important for purposes of qualifying for a retrofit. And then finally, we kind of got to the later part in 2012. We had the first rooftop solar PV project that also had a battery. And here, the uses explained in the private letter ruling included time shifting, frequency regulation, ramp rate, demand charge management, time of use. And in this one, the IRS applied for the first time a specific limitation and required the taxpayer to make certain representations with respect to the dual-use property rules in the 75% cliff. So, I think it took the government probably a little time to sort of ramp up on how they were going to apply the old regs to battery storage. And as taxpayers were coming forward with private letter rulings, they were issuing them on an ad hoc basis, on a one-off basis, and we had these 3 private letter rulings. Then we get into 2014 and 2015. We have 2 additional private letter rulings. These are not, I wouldn't say these are traditional pairing of storage with a solar or wind project. The first in 2014 was a distributed generation solar project, but it was really related to solar infrastructure and light poles. Not a traditional battery installation. And then the 2015 PLR was more on the basis of depreciation rules as they relate to a frequency-only installation of battery through the distribution and transmission grid. Really had nothing to do with electric generation. So these last 2 PLRs are not as not as relevant for pairing storage with renewable energy. So we got through about 2015, and then the government eventually issued a notice, said they were going to write regs, and we're going to come back to that. I want to hand the presentation over to Brian, so Brian can tell us about the new private letter ruling that was just received for a client under Section 25 Cap D, which is the residential credit, and I'd like us to spend some time on that because this is new and important for the industry. And let me hand it off to you, Brian.
Thank you, Gary. Thanks all for joining this webinar, and thanks ESA for having us here this afternoon. So we're really excited about this new PLR that recently was released to the public. This is, although it's related to the residential ITC, and everyone has been waiting for additional guidance and clarity on the commercial ITC. Any step in the right direction from the IRS is helpful to the industry and helpful for us providing clarity to our clients. So we were very excited about this one. This is a favorable private letter ruling that was issued by the IRS just recently for our client that was an individual taxpayer that had installed a solar system on his house in a prior year, and now wanted to install a battery on his home and claim the residential credit, the Section 25 Cap D, capital D, residential ITC for 30% of the cost of the battery. And the IRS ruled that taxpayer could claim the 30% ITC on the cost of its battery when it was paired with solar property. And that was the first issue that the IRS ruled on. And the second issue was that specifically the taxpayer could claim the credit even if the battery was installed in a later year. And so, as Gary talked about with some of the development of the prior private letter rulings and regulations, there had been some question as to retrofits. This is a really big deal because the IRS has never ruled or issued any guidance on the eligibility of storage for the Section 25D residential credit, and it's just one more marker for the ability to add storage at a later time and to qualify a retrofit for an ITC. So just to give you some factual background on the private letter ruling, and the actual ruling request process played out over a long period of time, so it took us many months to actually obtain this private letter ruling, and Gary went through some of the process of obtaining a PLR, but it can be a lengthy process. It often takes 6 months, and there's a filing fee often of $28,300. So it's significant time and expense that this individual put into obtaining this private letter ruling. So the background is that in year one, the taxpayers purchased and installed a solar energy system. This is your typical solar residential system, and they claimed the 25D residential tax credit on that solar system in the first year. Now, these are the same systems that if bundled together are often involved in tax equity deals, and on which a Section 48 credit could be claimed if the system is not owned by the homeowner. So just something to keep in mind. In the second year, the taxpayers purchased the battery, and that is to be integrated into the solar energy system. And so the battery includes an AC battery in this case, an inverter that converts the solar electricity between AC and DC, and the required wiring to interconnect the battery into the existing solar system, as well as a software management tool that monitors and controls the charging and discharging. We had also requested that the IRS clarify that costs and specifically labor costs allocable to the on-site preparation and installation of the battery qualified as well. So one item that we had many conversations with the IRS about, and we've talked with them about plenty of in the context of the 75% cliff that Gary discussed on the Section 48 ITC, but we had several conversations with the IRS as to the ability to qualify the battery if it did not use 100% solar electricity, if some of the electricity that charged the battery came from the grid. And at the end of the day, the IRS took a strict reading of the statutory language in Section 25D, and they said that this battery could qualify as solar electric property that is part of the solar energy system, but that 100% of the inputs into the battery had to be from solar. And so you see specific language in the private letter ruling that was actually issued that mentions that when the battery is constrained to charge only from solar, the software monitors these signals every 0.1 seconds and controls the battery such that charging only occurs when the solar energy system is producing energy and only up to the instantaneous solar power. So that is not, that's not the position we hoped or thought the IRS would take on that particular issue, but that's what that is what they ended up writing in the ruling request. Now, we don't think that this transitions or has any impact on the Section 48 rules, and we've seen some speculation in various articles that have been written about the PLR, wondering whether this would have an impact on Section 48. We don't think that this has, this by any means translates to requiring 100% solar charging on the Section 48 credit. Currently, that 75% cliff and those dual use rules in the old regulations still apply for Section 48.
Yeah, Brian, just to add an exclamation point on this, I just want to make sure no one walks away with the thought that in any way this 25D ruling restricts qualification under the 48 credit. It was very, very clear between the interactions with the IRS that their views with respect to this, this requirement in no application of the 75% cliff was particular to the statutory language under 25 Cap D. So it should provide there should be no inference with regard to the application of the IRS's previous rulings applying a 75% cliff with respect to the Section 48 credit.
Yeah, thanks, Gary. And so just some other factual background that's found in the ruling is that the battery, and this was one point that we spent some time discussing with the IRS, just that the battery also enables continued use of solar electricity in the event of a grid outage, and that integrating the battery into the system will enable disconnection so that you can continue to use solar electricity in the home in certain locations during grid outages. And this was in the wake of the recent hurricanes. And so, in discussing really how the battery does use solar electricity, does use solar energy to generate electricity, that's one of the ways that we were able to show that it did so. And finally, the useful life of the battery is expected to be shorter than the remaining useful life of the solar energy system, and so we just noted that the battery will likely need to be replaced at some point during the solar energy system, and it follows that we think that at that later point, that battery could also qualify for the Section 25D credit as well. So just some legal background that was contained in the ruling request. This is the language from the tax code, and really we were focused on qualified solar electric property expenditures, and that's an expenditure for property which uses solar energy to generate electricity for use in a dwelling unit. And that language is very similar, almost identical to Section 48, which says equipment which uses solar energy to generate electricity. And then on the next slide, we just lay out what the actual ruling requests were. These were the two issues that we requested rulings on, as we discussed. On the first issue, the answer provided in the ruling is that, yes, the battery meets the definition of a qualified solar electric property expenditure under Section 25D(d)(2) and qualifies for the credit. This may be something that a lot of you assumed was the case in the past, and we did as well, but it's something that the IRS has never stated, never published, and there was even some internal IRS conflict on this position, and so this is a big deal to have this actually written that a battery can qualify for the 25D credit. So in ruling that it could, the IRS said that the battery does meet the definition of under that section, and as I mentioned, the IRS compared the language in that Section 25D(d)(2) to that of the solar water heating in 25D(d)(1). So when it looked at solar electric versus solar water heating, in the solar water heating context, it requires that at least 50% of the energy used is derived from the sun. Like I mentioned, we tried to make that argument that same 50% requirement should apply for solar electric property, but the IRS focus was that because the statutory language makes no mention of that 50% requirement when it talks about solar electric property, that 100% of the energy should be derived from the sun. So they also talked about the software management tool and said that was qualified if it is required for monitoring the charging and discharging, and they also did rule that the labor costs for the on-site preparation, assembly, installation would all be eligible as well. And then that took us to the second ruling, which was whether the installation in a later year would cause any problem or if that was allowable. And the IRS said that yes, that was allowable, that the battery cost remains a qualified solar electric property expenditure when it's installed in a taxable year after the taxable year in which the installation is completed. Note the use of the terms taxable year. It doesn't specify which taxable year. And then just to note on the next slide, yes, this slide, the legal standard of the PLR, there is the language that's standard in all private letter rulings, and Gary mentioned this as well, that this PLR is only directed to the taxpayer who requested it. PLRs are not precedential, and that is true. However, I will say that a PLR is the best indication of the IRS National Office's current view on an issue. And I think an IRS agent or local counsel would be hard-pressed to challenge a taxpayer that has an issue that is identical to one that the National Office just issued a private letter ruling on in a favorable manner. So, although you have to take caution and can't specifically rely on this in court, this is a window into what the IRS is thinking and what their position is right now. So just some takeaways from this PLR. Like I mentioned, it's the first PLR in this area to mention storage, electric storage, and specifically adding storage or property in a later year and claiming the Section 25D credit. The IRS position here removes a lot of uncertainty for taxpayers that had purchased their solar systems for their homes in prior years and are now considering installing installing storage or battery at their house. So, as we've seen lately, more of a move towards cash sales of solar systems, and we think that we'll see more and more taxpayers claiming the Section 25D credit now.
Hey Brian, maybe we can address, there's two questions here since you're on this topic. I think now would be a great time to address. The one question is, does the battery have to be installed within some period after the solar is installed, i.e., the second question, any later year, no time limitation to be concerned about at all? What say ye to that question?
That is a good question. The language in this PLR is fairly general in terms of the installation being in a later year, and so our position based on our interactions with the IRS on this PLR would be that it doesn't matter in which year, as long as the property would be eligible for the credit, as long as the Section 25D credit is still available and still enacted in law, then our position is that you could claim that credit on the storage device on the battery in a later year. So at this point, that takes us to when 25D is currently set to expire, which is in, let's see, if you can flip back to that slide, Gary.
It's calendar 2021.
Property placed in service in 2021. So certainly we think that through 2021 at this point, you can add a battery to your solar system and claim the 30% credit.
Yeah, and I'll just add to that, Brian, like, you know, a real important thing in the PLRs to date on pairing storage with solar or wind has been whether the storage is integral, which is defined in the regs, and the 48 regs is used, directly used and essential to the completeness of the qualifying function. There have been some that thought that the battery had to be installed at the same time as the solar equipment, what we would call functionally interdependent. And I think the IRS has ruled numerous times now that that is not the case. So hopefully this puts to bed the concern about retrofits not qualifying, that a battery can still be an integral part even if it's placed in service 1 year, 2 years, 3 years after the solar or the renewable energy resource.
Yeah, and I just want to correct what I just said about the 30% ITC being available if placed in service by 2021. If the battery is placed in service before 2020, then the 30% 25D credit would be available. If the battery is placed in service in 2020, the 26% credit would be available, and if placed in service in 2021, the 22% ITC would be available. But we think that's regardless of the year in which the solar system was initially placed in service.
Okay, so we're going to move on to looking ahead. So there was a period of time here, the IRS in 2015 put out a notice saying that they were going to write new regs, and those regs were particularly slanted towards addressing battery storage. ESA, along with SEIA and numerous other trade industries and folks wrote comment letters to the government. ESA actually met with the government. Brian and I participated in that meeting along with Jason Burwell and others, and we went through our asks with respect to the guidance. The government was making some progress on the regs, but then tax reform happened. The government publishes their priority guidance plan on a periodic basis, and this used to be on that priority guidance plan. This project has fallen off of that priority guidance plan. Given what the government, Treasury, and the IRS has on their docket of the most immediate stuff they have to address with regard to tax reform, it is improbable that anything is going to come out with regard to these to a new set of regulations under the energy property rules under the ITC anytime soon. This slide is sort of a hypothetical. If everything worked out, maybe we got final regs in 2020. I think the bottom line is no one knows. This is on the back burner until or unless there's capacity to pick this project back up. What that means for the industry is you can't expect any further guidance coming from the IRS, anything actionable within the next several years. So bottom line, let me explain another event. So there was a meeting between SEIA and Treasury. David Cotter, the Assistant Treasury Secretary, Tax Policy. For a short time, he was also acting Commissioner of IRS, to request that if the government isn't going to make and keep the energy tax credit regs on the front burner, and it wasn't going to be part of the priority guidance plan, that Treasury and the IRS go back to issuing private letter rulings. So taxpayers could transact on the fringes where there are still open questions. To my knowledge, no one has tested the government yet with respect to that. The ruling that Brian went over was again a ruling under 25 Cap D. That was outside the scope of that reg project, And now is a great time. If you have a specific configuration, an issue that you're getting flack from investors on, regarding a qualification for the Section 48 credit, now is a great time to go into the government for a ruling. Right now, it's not clear that they will rule, but my sense from attending that meeting is with the right pressure, they will go back to issuing rulings with respect to these matters. So as part of our final thoughts, I would consider submitting a private letter ruling. There was a question from one of our participants. Let me find it again. Urban legend or truth? You need to get a PLR to get renewables plus storage project financed. I will say that is an urban legend. We are seeing projects get financed with tax equity involving solar plus storage. So I don't think the market still requires on every single deal a one-off private letter ruling. The 25 Cap D ruling should help that further, particularly with respect to retrofits. But I also know enough from having participated with clients and meetings with the IRS, there are certain configurations where a ruling is probably warranted, where it's not as clear, like a utility scale project where the battery is before you get to the substation and you have the right measurements in place and you can make all the right reps. Those types of projects might get financed by an investor. They might put risk on the sponsor with respect to challenge, but those deals should be financeable. When you get to other issues in certain configurations, then a ruling might be warranted. So final thoughts, I think we should think about rulings in this area. It's always important to implement and kind of have your strategy for ITC eligibility up front. There is probably an issue or a question about separate ownership. Can one entity own the battery storage device with another entity owning the solar facility? It's Deloitte's view that that is supported by the law, but the IRS hasn't ever ruled on that particular matter. So that might be a good matter for rulings. Record keeping and metering and configuration and how you're going to measure the time period that you measure, the charge, discharge of the battery. Is it every 15 minutes? Is it 4 times a year? Those are all really important matters that can impact qualification under the 75% cliff. So these are all additional matters that could gain further clarity by a private letter ruling. Anything, Brian, you want to add in final thoughts here?
No, just any final questions before we wrap up? And if there isn't time for additional questions, feel free to reach out to us. Our contact information is on the last slide.
I see one question we have time for here, Brian. Would ancillary structures accommodating batteries necessitated due to space constraints for the battery system be eligible? What say ye?
I would say yes, they generally would be. There is IRS guidance on Section 25D where they have said that the solar property does not need to be attached to the house directly, and so there are instances where the solar property can be next to the house or nearby and still qualify.
All right. We have a question. Can you have separate ownership of the battery and the solar system still qualify for the properties? I think we answered that one. 2 other follow-up questions. Could you comment on the applicability of the PLR to commercial applications? Does the PLR imply single taxpayer's owner? What do you think of that one, Brian?
Again, I think there are some implications for the Section 48 credit, but only favorable implications, no limitations that are applied to the 48 credit because of this, but maybe this provides some further support for retrofits and maybe some other tangential issues.
Great. I think we're at the top of the hour. Thanks for everyone joining. You have our contact information on this last slide. Feel free to contact Brian and I, and we'd be glad to assist further. Appreciate the opportunity to participate today.
Thank you.
Thank you so much, Gary and Brian, for the wonderful information. I also want to thank everyone for listening in today. I just want to remind everyone that a couple quick things. If you haven't already done so, please plan to register for the 2018 Annual Conference and Expo that will be in Boston from April 18th to 20th, and you can find more information about it at www.energystorage.org/readyforbusiness. I apologize that we weren't able to get all the questions today. We as Brian and Gary mentioned, you are welcome to follow up with them via email, and I will also share your questions with them following the webinar today. Thanks again, Brian and Gary, for the really wonderful information and the great presentation, and thank you to everyone for attending today. Thanks all. Have a great day, everyone.